I want to talk about the melt up. So, you talked about the melt up and then the credit event that you think was going to happen. So, the floor is yours here. I'll let you just lay it all out, kind of your thesis on the melt up, like why and where you see kind of the credit event coming.
So, first of all, let me preface this by saying, as much as with hindsight, you can argue I've been right in terms of, the content and the pivots and the analysis. The reality is, in my world, that none of that being right mattered last year, because in my world, my rules-based funds use treasuries as the safe haven risk-off play. The signal was right for pretty much all my funds to be risk-off the bulk of 2022, but it didn't matter because treasuries acted worse than equities for the first time in history. Right? So, as you know, right, this is the only domain in life where you can be right and lose money, or wrong and make money. Right? So that's an important thing I think we should tease out more, because it's more than just the analysis. It's the execution on the opportunity set and where you are in the cycle of the opportunity set, right? Which is a really important nuance. So back in April last year, I was very loud saying the environment was worse than 2008 and worse than 2020. I said it was hell. And I was seeing that because equities and treasuries were acting the same. The flight to safety trade was failing, which explains a lot of the drawdown in my own funds. Mid-June, I started saying melt up, actually. It wasn't really in October. Mid-June, I put a tweet out with an image from CNBC that day. It was like June 16 or 17. And the headline from CNBC was markets in turmoil. And I'm telling you, that is unequivocally always, historically a bottom. All right. So the sentiment was so dark. The media was on it. I said melt up back then. Then August 10th, anybody can look it up on the tweets, even though there's a lot of tweets. I said every W needs a V, which is basically double bottom. Right. And then I went back to, the end of the world's at hand. That's why meltup's about to take place, October 3rd. There was a brief period in December where I said stocks, I believe, are likely to have an imminent crash. Stocks didn't crash, but the fifth worst December in history. So I'll still take that as a win. The conditions were there for the accident, and it was a bad month. Entering 2023, somebody tweeted me saying, what do you think? You think still we're at crash risk? I said, I'm not clear on that. And then I started seeing lumber pick up. I started seeing utilities start to break down, all the leading indicators I'm known for. And I said, okay, we're back to melt-up conditions, right? So let's talk about why. Okay, first of all, it's not an opinion, okay? When I say conditions, it's not about directions. It's about probabilities, right? The conditions that favor an outcome. Historically, not my opinion, when utilities are underperforming the stock market, the conditions favor lower stock market volatility going forward, which is what risk on is. Historically, when lumber is outperforming gold, conditions favor lower stock market volatility, which is what risk on is. So both utilities and lumber, after a prolonged period of being right, saying risk off, we're starting to flip saying risk on. Okay. But it was also happening at the same time there was tremendous bearish sentiment. Now, I can't really test that bearish sentiment, but I can see it qualitatively from the responses on FinTwit. So I saw that my own strategy started flipping from being defensive to offensive. And here we are, and you've already had a pretty sizable move, and everyone seems to be offsides on it. What is remarkable to me is that the bear narrative remains the same, even though it seems like every single point has been, at least for now, countered, right? So strong jobs data, Powell has to beat the bulls. Okay, except that every time now, last two times between last week and this week, Powell's spoken, markets rallied. Powell actually wants to see the market go higher because you had the seventh worst year for the S&P 500 in history on a real return basis. A lot of damage has already been done. There's another interesting dynamic, though, about this melt-up, which I go back to, is behavioral. Last year, 59% of the weeks, the S&P 500 lost money. So you had a very consistent decline in U.S. stocks. The only other time in history you had that number of weeks down as a percentage of the year was 1931. You're not supposed to be able to consistently make money shorting. That's not how markets work, right? You tend to have these, usually it's staircase up, elevator down. Last year was staircase down. And that was part of the whole melt-up thesis October 3rd, that the market conditioned people to be bearish because people were so profitable being bearish week after week after week after week, even though that's the anomaly. So if you condition people a certain way with the sequence of returns, markets do what they do, which is they recondition you.